Right. Well, it gives me great pleasure to be here. Just a big thanks, I guess, to David and Glenn and all our sponsors for putting on a nice AltFi and the weather today. Obviously, for the Kiwis here, it's really pleasant. But let's introduce our panelist, Garth. I had the pleasure of receiving some great notes from Garth on what he'd like to add today for our Australian audience. Garth is a grad from Auckland University. He went straight after 1994, I think, when he graduated to Crown Law. And it can be all on LinkedIn there, Garth. He was at Crown Law, which is obviously a government department. Did a small stint at the New Zealand Stock Exchange and went back to the government, which is in the Financial Markets Authority, which we'll touch on a little bit about now. So Garth is the Director of Capital Markets, so great authority to have with us today. Neil's certainly been in the consumer finance space for many, many years. Neil's background is AGC Finance, Pacific Retail Finance, and here in Oz, Flexi, and back in New Zealand, where Harmoney, which he founded and is the co-CEO, and then back here in Australia with a little bit more Harmoney. Lachlan, he's really big in the financial services space and markets, 15 years with Citi, UBS, and Deutsche Bank, and I think it was March 2015, Managing Director of Spotcap Australia, and now New Zealand. Done you guys some justice? I hope. Good. Right. One of the things that I find really interesting is I originally actually started the concept of Society 1 or peer-to-peer lending in New Zealand in 2007, and I visited the Securities Commissioner in 2008 and told him about this great concept I wanted to get into. Said, look, it's big in the UK, we should be doing it here. I was shown the door very fast, said it's illegal for a borrower to raise money from the market without a prospectus, and that's expensive. Interestingly enough, I put my tail between the legs and moved to Australia shortly thereafter to set up Society 1. But it's in 2011, the Securities Commission was replaced by the Financial Markets Authority, and shortly after that, in 2014, we had a light reg in marketplace lending, which was really proactive, something that was quite different from what we saw here in Australia. Garth, could you maybe talk us through a little bit of that process?
Yeah, sure, I'd be happy to. So just to put it in some form of context, I think it'd be fair to say the state of sort of capital markets / securities law in New Zealand in the late 2000s was pretty poor. The good thing about that was that there was a full sort of review done and by a body called the Capital Markets Development Task Force. And coming out of that was a desire to make the New Zealand capital market system a lot more proactive, a lot more user-friendly, a lot more innovative. And one of the other things that came out of that was the formation of the Financial Markets Authority, which was designed to be a very proactive and very market-facing legislator, as well as a whole lot of bespoke regulation that was supposed to basically create a whole ecosystem of New Zealand capital markets that was both fair, efficient and transparent, but also promoted innovation. And so one of the interesting areas in that was the creation of the licensed intermediary services, both peer-to-peer and crowdfunding. It would be fair to say there was some nervousness on the part of the board, our board at least, because it was quite a difference from the system that had pertained before, both on the equity and the lending side, in the sense that previously there had been quite a lot of regulation in terms of product disclosure statements that were required, whereas going forward, basically we licensed intermediaries, but the particular offers themselves went through those intermediaries but weren't licensed. It would be fair to say from our point of view, it's actually been a really good process. It was really, really helpful. We had a very, very clear direction from our government about what they wanted, which was for us to be facilitative and not to put up a whole lot of roadblocks. And then we were also lucky enough to have some extremely competent companies come to us. So to take Harmoney as an example, given Neil's just sitting on my left, it was obviously a new concept, but the application that we received from them, very good governance, very good engagement with us, good people that were involved, had clearly thought about all aspects of the equation. So one thing I would say, looking at the fintech space more generally, is we often get people coming to us who take innovation in and of itself as a reason to be licensed or a reason to be authorised, whatever it is, where it's important to actually think about the potential risks of your product and how you're going to mitigate those. So overall, it's been a really, really positive experience. The New Zealand legislation is extremely simple, and that's great, but we had the clear support of our government to be facilitative, which is what we've been.
Oh, it sounds great, and it sounds like a clean bill of health there, Neil. So any comments about your experience, your submission process with the FMA?
Yeah, sure. So Harmoney was the first licensed peer-to-peer platform in New Zealand, and the gentleman sitting to my right actually signed that license. So apologies in advance for any sucking up, but you can't really miss the opportunity. So yes, so we watched this piece of legislation go through Parliament, and some of the encouraging signs we saw early on, because we were still thinking about investing and putting our money, time, careers into peer-to-peer, was there was a recognition that more compliance per se doesn't stop businesses that are perhaps fraudulent by nature, or they're actually go out of business. So that was pretty forward-thinking, I think, in terms of the government approach. We were required to take the regulations, take the rules, and rather than have a lawyer or any outside entity do this for us, the operators of the business needed to articulate how we would actually comply with the license conditions throughout our whole business. So, we found that whole application process to be robust. The engagement with the FMA had been, very good, and subsequent to that, we engage regularly in a regular update call, but also if there are questions that we have or issues that come up.
So I think there are 8 licenses now that have been issued in specifically the space of marketplace and alternate lending. It is very different here in Australia. I think we all adopted managed investment schemes and have modified them to suit the purpose of what we do in marketplace lending or peer-to-peer lending. But the interesting thing is and there has been, ASIC's been really good with regards to forming a relationship with many of the participants and getting feedback. In Australia, we've actually just come up with guidelines really of how to operate in the space, but it's really interesting to see New Zealand really take the bull by the horns, get some light regs in place, which gives you a really clear indication of how to play. I guess the question is, this is a question for Garth, the Commerce Commission has recently wanted a point of clarification of law around fees and platforms regarding marketplace lenders, as an example. This is probably Harmoney's first mover disadvantage to a degree. Is there an issue with light regs sometimes in this case where there's a bit of a disconnect between the various government departments? Garth?
Well, thanks, man. That is an awesome question. Look, I do think it's important as a general point that if government is promoting innovation, then ideally, yes, you would have all government departments joined up. As it happens, that isn't unfortunately always the case. I think in this particular case, it was probably an example where actually 2 bits of legislation just don't mesh that well together. So our sort of credit contracts and Consumer Protection Act and our Financial Markets Authority don't quite mesh together. So I think it was definitely a case where there should have been slightly more cooperation between us as the markets regulator and the Commerce Commission as the sort of credit contracts lender. It's in terms of when Australia comes to redesign its legislation in this area, that would certainly be something I would advise looking out for. That consistency across statutes is really important, I think.
This is not enforcement, obviously. It's more point of clarification, some real school fees here. Neil, any comment?
Yeah, it's actually a case-dated procedure. It hasn't been used that much before in New Zealand, but it utilises Harmoney as a case study and asks the courts for a clarification of law. It's been knocking around for a wee while, and we've quite some time ago adjusted our business accordingly. So in terms of a Harmoney effect going forward, hopefully it won't have too much of an impact. But we obviously learnt about that a little late in the piece in terms of that regulator point of view or desire to actually seek clarification, which was a bit of a challenge. But
So I guess moving from light rig to no rig, SME lending, interesting here in Australia and in New Zealand. Really, you self-regulate at the moment. Lachlan, talk a little bit about some prep that you guys are doing with regards to obviously your experience here in Australia, but also moving into New Zealand, contrasting the two markets. Was it just a cut and paste to go to NZ and do it, or I know the Trans-Tasman rivalry generally says it shouldn't be. How do you feel about that?
Yeah, it's an interesting question. So we started Spotcap about 3 years ago in Australia and decided just over a year ago that we should have a look at the Kiwi market. Now, all I can say to the people in the room here, if you're ever thinking about doing business in New Zealand, it's actually way easier to set up and do business in New Zealand than it is Australia. The government's been very, very proactive in terms of providing all of the infrastructure, especially for a lending company, that we need to do. I mean, Companies Office, the APIs that are available are just insanely good. And you know, I would strongly recommend the regulators sort of have a look at that model, you know, if they're ever thinking about beefing up the stuff that's servicing the lending market here in Australia. The decision internally for us to go to New Zealand, from when we made that decision until we actually went live in the New Zealand market, took us 6 weeks. Admittedly, we have built a quite a unique platform that we can sort of drag and drop into a new market, but we already had a lot of the integration, with the banking partners and the credit bureaus and the data providers, etc. And they're quite similar, not exact, but quite similar between Australia and New Zealand. The main difference that I find about the Kiwi market is it's quite parochial in its nature. We have our sales team based locally in Auckland, but we run a lot of our client service and risk functions out of Australia, and it's often funny to hear the Kiwi customers on the phone to our Australian client service team and understanding that they're actually based in Sydney and servicing them in New Zealand. So that's always fun to hear. And in terms of the regulation, I haven't had to sort of go through the journey with the FMA like Neil has done, as we operate in an unregulated market in New Zealand, be that small business lending. But as an industry, and especially here in Australia, and there'll be a panel that sort of talks a bit more in depth about that later this afternoon, we've really taking a proactive stance, because as the industry grows and becomes more mainstream, and we may have a couple of our players IPO later here in the year, the regulator is going to be drawn to this sector, and so we've really taken the view that as an industry we've got to come together and regulate ourselves, or at least prepare for the market to be regulated. Spotcap is a global business, and we operate in many countries, and we're regulated by the FCA in the UK, and we run all of our global operations to that standard.
And just on that point, I mean, that notion of people self-regulating and thinking ahead to when the space is going to be regulated, I think is an incredibly healthy one. And just as a general point, I'd say, you know, I often appear on panels where the general theme of the panel is regulation against innovation. Regulation is a blocker to innovation, some variation on that theme. I would really encourage all of you who are either thinking about moving into a business which is going to be regulated, or are just thinking about the long-term sustainability of their businesses, to think really closely about, to sort of reframe the question into the fact that regulation, far from being a blocker to innovation, should actually be something that helps sustain it and helps support its long-term sustainability, because the things that make for sustainable long-term viable financial services, things tend to stay the same over time, no matter how innovative that product is, and that will be good quality disclosure to your investors, very effective governments, and control of conflict management. I'd say would be three of the biggest things. So all I could say is, for God's sake, don't take the attitude that regulation is just some compliance burden that's a complete pain in the ass, although it may turn out to be, for all I know. Think of it much more in terms of, this is actually something that can really assist our business in whatever way, shape or form it is, have a long-term sustainable future.
Been turned off. I guess one of the biggest topics that we have here in Australia is our comprehensive reporting, or should I say lack thereof. It's very close. It's been a long time coming. Both your businesses, Spotcap and Harmoney, you guys have credit underwriting processes on both sides of the ditches, so you actually get to see the benefit of comprehensive reporting. Neil, from your point of view, now that you have an operation here in Australia as well, could you try and summarise actually that genuine benefit when it comes to underwriting risk?
Yes, absolutely. So obviously there's a negative bureau reporting environment, has been there for some years. It's pretty robust. Positive reporting has been available now for a year and a half, 2 years in NZ, and as more and more banks and other financial institutions and utilities have joined that program, that set of data has become more and more robust. We're on our second generation of scorecards, and that fully utilises in NZ positive reporting, and allows us, so last scorecard we deployed allowed us to approve 30% more with 30% less loss. But perhaps more importantly, we're heading towards full automation. And for the first time, we don't have to utilise what you know as a credit application, which we're all used to, but really when we think about it, we don't really like a credit application. There's not much to like about it. So utilising data sources and then feeding those back to consumers and getting confirmation is the direction that we're going in. Obviously, we are waiting with everybody else for that positive regime to get some traction here and to get access to it. Other than that, the data sources, Greg, are pretty similar.
Yeah. Lachlan, I'm keen for that answer from you as well, but cold start scorecard, you know, on SME lending, you moved into New Zealand, made the decision in 6 weeks. How do you pull that off when you have incumbents that have been lending into that space for a while? You have no vintaging, no track record in that space. How do you start on that basis?
Yeah, we start with a thing called an expert system where you make a whole lot of guesses, essentially. But we took the view and we did a lot of modelling, you know, as to the similarities and differences between the two markets. And what we did have was the benefit of 2 years of performance data in our Australian business, and then being able to sort of apply that into our Kiwi operations. I mean, for want of a better word, our Kiwi operations still operate off what's known as an expert model. We're constantly updating that. But our Australian business, like Neil, we're moving into our second and third generation performance models now that incorporate a lot of the data that we have, especially from our non-performing loans and loss rates, and feeding that back in, you know, to the models to hone the scoring. In terms of the question about credit, the credit reports, and I know our friends Equifax are here, but at this point in time, we find credit reporting is becoming less and less important for us as we go through and build out our models. I mean, performance data and bank account transaction data is now, you know, sort of circa 75% of the analysis that we do. And we even now know when we're not going to lend to a client, we won't even pull their credit file. And that's the same in both markets. So in terms of the CCR implications, I think in SME, for us in particular, it's becoming less and less relevant.
So we'll get moving on to some of the questions here. And it is a really interesting one, I think, that very first one. You're talking about a population size of around 5 million versus 25. It's a small market. Harmoney has shot the lights out on the numbers too with lending. It's 800 million plus.
Yep.
So it's a large peer-to-peer lending business in a population of 5 million. Internationally, I think if you look at per capita, I think that would rank as one of the largest per capita. I think lending running.
Yeah,
we leave China out of it.
Yeah, outside of China. Yeah.
So to answer the question there, I guess, Neil, it obviously is big enough, isn't it?
Is it big enough for more players? No, absolutely not. No. The market over there is about $15 billion, and I think that we're starting to see a lot of incumbents really get serious about automation, and we're starting to see more and more startups coming into the space. So the competition is pretty fierce, and we expect that to intensify over time. Interestingly, you know, personal loans is the only category where we've seen a real price reduction for borrowers, which is good to see. The other parts of consumer lending certainly haven't had any sort of reduction for borrowers in line with the reduction in cash rate. So I think the competition's good for both sides of the marketplace, to be absolutely honest.
Now, Noah wasn't going to give away his channel of best CPA earlier, but in your case, New Zealand versus Australia, if you had a look at the channels that really fire for you, broker, direct, TV, above line, below the line, where is, Lachlan, you can head this one, where is the majority coming from? Where's the good quality coming from without giving away the secret?
I mean, they're kind of similar to Australia, but what we find as an SME lender in New Zealand is there's way less competition over there. You know, and I'm sure our friendly competitors will have a look at the market and move over there in some way, shape or form in the foreseeable future. But I mean, things like online, the cost per click, way less. SEO, we rank, quite easily on the first, page, often 2 or 3 times for keywords that we're engaged with. But also things like a broker channel, the broker channel. So it's about finding the right, broker channels and getting on panel with those particular lenders and getting out there and doing a lot of the marketing. I mean, we haven't even touched some of the other stuff like Xero. I mean, sort of to answer the next question that's coming up there, the Kiwi market has a very, very digital savvy population, and all you have to have a look at is the penetration of products like Xero into the accounting channel over there. That gives you an indication as to how willing they are to adopt fintech as a new sort of product origination channel for products that they're searching for in financial services.
Neil?
So in terms of differences between both markets, we're finding them fairly similar. Obviously, you don't have the penetration of comparison sites to the degree you do here, and that would probably be one difference. We follow a fairly similar marketing regime, a little bit of direct mail, which is probably common amongst most platforms, and then a highly skewed spend towards digital, but a little bit of brand building above the line as well. With the exception of the last comment, very similar here in Australia.
I'm interested on the rate comparison site, lack thereof, in New Zealand. Do you see that as a positive in New Zealand in comparison to here in Australia? Because the comparison sites really are all about from rates. It's all about getting to the top and buying your way to the top of the list, maybe doing some promo deals. Are you a master of your own destiny more in New Zealand because they're not as prolific as they are here, potentially for your product offering to market?
I think that you just swap your dollar spend with a different means of originating. To be absolutely honest, so what we wouldn't spend on comparison sites, we're probably spending with the likes of perhaps Google or other referral sites, and it won't be long before we see comparison sites getting some traction in New Zealand, I think. Yeah.
Great. Well, I think that's about us. We're out of time. Thanks for the questions as well. Much appreciated. Big round of applause for our panelists.